Yorkshire Building Society now allows you to buy your first home if you're a first-time buyer with just £5,000. This video is brought to you in partnership with Leni, an app that my friends and family frequently use to send money to Ghana. Leni is an app that enables Ghanaians living in the US, Canada, and the UK to send money to Ghana and 9 other African countries at zero transaction fees. They also offer the best rate in the market, which means you always get the best value for your money. I have been using Leni to send money to my friends and family in Ghana, and I can assure you that it's a hassle-free and a zero-fee way to send money to your loved ones. To download the app and receive a £30 cashback on your first transaction of £100, please use my referral link in the description box below. But if you've already downloaded the app, then just put in my referral code as DCI. Thank you. Last week, the Yorkshire Building Society introduced their bold £5,000 deposit mortgage scheme, which means that with just £5,000, you could be a homeowner. But is that such a great deal that you should be excited about or even be considering? What are the details in that deal that they are not telling you? And are there better alternatives that you should rather be thinking about? I'll tell you all you need to know about that in this video. Stay with me. So what is this new scheme about? Well, we know that usually the banks would require you to have about 5 to 10%, to buy your first home. Which means that if you are buying a house worth 200,000, then you should have about £10,000, which is 5%, or £20,000, which is 10%. And that can be hard to raise, to be fair. But under the new scheme, you can put down just £5,000 if you are buying a house worth up to £500,000. Which means that if your house is costing £200,000, the bank, or in this case, Yorkshire Building Society, can lend you up to £195,000, and you only put down £5,000, which is 2.5%. And if you're buying a house costing £500,000 too, you can put down £5,000, which is 1%, and they'll give you the remainder £495,000. So this can be an exciting way to get onto the property ladder, but this is the catch. Under this new scheme, you can only buy a house which has been previously occupied, meaning you cannot buy a new home. Of course, it doesn't specify how many years the house should have been. Whether it's just 2 years or 5 years or 20 years, it doesn't matter. As long as you are not buying a new home, you are fine. And it also does not apply to flats. So you cannot buy a flat and you cannot buy a new home. Other than that, you can buy a house which has been previously occupied, whether it's semi-detached, detached, or a terrace. It doesn't matter. This is also not available in Northern Ireland, so it only applies to people who live in England, Scotland, and Wales. Other than that, you are good. But here is the other catch. That's at a 5.99% mortgage rate, nearly 6%. And that can be quite high in the current market because if you're putting down 5% or 10%, you could have something around 5.5%. In fact, I know somebody who recently got a mortgage for 5.2%, and they have, just a normal, credit score with 10% deposit. So that is something you need to consider. And one may say that, Sharak, the difference between, 5.5 and 5.99 is just 0.5, or the difference between 5.2 and 5.99 is just 0.8. But on a 200,000 mortgage, that can add up. And so that is something you must be aware of. In fact, let us look at the numbers. But before we come to the numbers, this mortgage is not directly available with Yorkshire Building Society. You have to go through their mortgage brokers who are Accord Mortgages. And I'll put a link to their website in the description box below. Also, the maximum age you can take this mortgage for is at the age of 70, which means that if you are 35 years at the time of applying, then you can get a 35-year mortgage. But if you are 50 years, then you can't take it for more than 20 years. So that's something to bear in mind. Now, let's look at the numbers, how they play out. And we're going to compare 3 scenarios where we're buying, 3 different property sizes. One costing 200,000, the other 250, and the last 300,000. And let's see how the interest rates add up in 3 different scenarios. One where we are taking the deal from Yorkshire Building Society, where we put down just £5,000 deposit. And the other 2 cases, we put down, say, 10% deposit at, one for 5.5% mortgage rate and the other 5.2 mortgage rate, because these are the realistic rates, in the current market. In the first case where we are buying a property costing 200,000, if we are going with the Yorkshire Building Society deal, it means you only need a £5,000 deposit. But in the other 2 cases where we put down a 10% deposit, that means that we put down £20,000 in both cases, which means that for the Yorkshire Building Society deal, we would borrow 195,000, and in the other 2 scenarios, we borrow 180,000. The monthly mortgage for the Yorkshire Building Society deal works out in the case that the monthly mortgage works out at £1,256 per month if we have to take a 25-year mortgage. And in the other two scenarios, we have 1,105, and the other case 1,074. Of course, the difference is not that much, but you quickly see that the interest on the mortgage, so of the 1,256 that we pay for the Yorkshire Building Society, about £974 alone is interest, which is quite high, to be fair. In the case of, if we get a mortgage of 5.5, the interest alone is 824 and then 781 for 5.2 respectively. So we see that the interest rates are quite high. But of course, you can argue that the difference is not that much, but over the 5-year period, which is the period for the Yorkshire Building Society, you would have paid an interest of £58,440, and that is quite some amount. This compares to, if we put down a 10% deposit for 5.5, we would have paid an interest of 49,500, and of course, in the last scenario, we would have paid 46,860. That means that over the 5-year period, if you had put down a 10% deposit at 5.5%, you would have saved yourself £8,940 in interest alone compared to the Yorkshire Building Society deal. Now, the question is this really, that much, or, is it really, that different? I guess so, because I can imagine what you can do with, nearly £9,000 over a period of, 5 years. This is in savings in interest alone. So that you clearly see that. And if you had even got the mortgage for even 5.2, you'd have saved yourself a whopping £11,580 in excess interest alone. So that is something to consider. So you clearly see that the Yorkshire Building Society, while it's good, and because it gives you a very little deposit to own a home, it doesn't come at a cheaper price. It comes at an expensive price. It even gets worse when you look at a 250,000 property, whereby we put down £5,000 again for the Yorkshire Building Society deal. You can borrow up to £245,000. This compares to if you had put down 10% for a 225,000 mortgage in both scenarios, because you've put down 10%, which is 25,000. The monthly mortgage for the Yorkshire Building Society one works out to be £1,577 per month, and the other ones work out to be 1,382 and then 1,342. And we see that the difference between even the mortgage payment is £195 compared to the Yorkshire Building Society deal. Of course, it's just under £200 difference in terms of the monthly mortgage payments. But you can imagine what you could do with that excess £200. You could either overpay or even put it into an investment account. And that is something to consider. Let's look at the interest. The interest on the mortgage alone for paying £1,577 per month is £1,224. So that is not cheap for a 250,000 property. This compares to 10314, a 5.5% mortgage, and obviously it's 976, just under 1,000 for a 5.2% mortgage. And again, the difference is we see that over the 5-year period, you would have paid a whopping 73,440 in interest alone to the Yorkshire Building Society over 5 years. This compares to a 10% mortgage at 5.5, which is nearly 62,000, and the last case nearly 60,000. And the differences again are very clear. In the case of a 5.5% mortgage, you would have saved yourself £11,580. Still, it's not a cheap mortgage, but at least it's saving you over £10,000 in excess interest alone compared to the Yorkshire Building Society one. And of course, if you get it for even 5.2, that is nearly £15,000. So the numbers continue to add up. When you go to a 300,000 mortgage, you would have saved yourself over 5 years, you would have paid about 88,000, nearly £100,000 in mortgage interest alone. And of course, the difference is such that you would have saved yourself about £18,000, if you got a 5.2% mortgage with a 10% deposit. So we clearly see that while the mortgage with the Yorkshire Building Society is good to get you to the property ladder, it is not a cheap mortgage, and you need to consider other expenses, before you take it. Now, the question is, what could you do with these excess monies? And I think the answer is clear, and I'll do another video where I actually show you what you could actually do with those monies. So Do you think this is a good deal for you to go for, or you think it's too expensive that you'd rather wait and put down 10%, or you'd rather put down more? And here is the catch. As you wait, of course, property prices can go up or they can go down. So that is something you should be careful about. But I think that if your current rent, you see, is around the 1,000 mark for the property that you can buy for, say, 200,000 or 250,000, then you may want to consider going for this mortgage, because even though the interest on the mortgage is, is nearly £1,000, if your current rent is just around the same price, then instead of giving the money to your landlord, you might as well give it to the bank and then own the property. So this is one of the conditions I think under which, having this mortgage can be reasonable. Of course, there's also potential to earn some income. If you buy, say, a 3-bed property for that price, you may be able to let out one of the rooms, or get, say, a friend to stay with you who would pay a bit, say £500, and that can reduce the amount of interest you pay in the long term. But you want to look at the numbers and make sure that they do add up. If not, you end up paying a lot more in interest. Does that make sense? Otherwise, let me know in the comment section what you are thinking about this, and I'm more than happy to explain even further. I also think that you can consider this deal if you think you can afford it. But here I would sound a caution that affordability is not just about the cost of the mortgage per month. It is also the cost of utilities, your cost of feeding, your car, your transport. These also do add up. So if the monthly mortgage is, say, 1,200, it doesn't mean that that's the only cost you'll be bearing. There are other costs to bear in mind. And also, if you own the home, you are supposed to pay home insurance, which otherwise you wouldn't pay if you were a tenant. Of course, home insurance may be just under £50 or something. But there may be certain costs that will not be covered under the home insurance. For example, if something was to spoil in your home, you may have to fix it on your own. So these are costs that you must bear in mind. I'm not seeking to discourage you from buying a place. All I'm saying is make sure the numbers do add up and that you can afford it. As I've already explained, you may get a tenant who may help you co-pay for the house, and that can help reduce your cost. But it's not always promised that you get a tenant or even your tenant would pay, unless, of course, you know them and they are a friend. That is something to bear in mind. Another thing to bear in mind when it comes to these, high mortgages is that, for example, if you buy a house costing 300,000 and so you put down just 5,000 and borrowed 295,000, fantastic, you own your home. But what if house prices should drop in the next few months or even years? You'd go into what is known as negative equity, whereby the value of your home is lower than the amount of mortgage you own on it. We know that house prices has been rising in the last few years, which is good for now. But what if at the time of remortgaging, your house now costs, say, 270,000? The house that you bought for 300,000, house prices have dropped now that it's now worth 270,000. But you have a mortgage of 280,000 on this house. This means that you owe more than even the value of your home. So that should you even sell your home, it still cannot pay for your mortgage. And that is not a beautiful situation to be in. This means that remortgaging can be hard. It can be expensive if you come to the end of the 5th year. But there's a way to deal with this. It simply means while you live in the house, you have to make sure that you are overpaying if you can. You want to build your equity in the house. And that is why I think that the size of the property you buy do matter. Don't buy a property that is too expensive, that your monthly mortgage is too expensive. I think that I'd rather have a cheap mortgage and then I would decide to overpay rather than having a mortgage that is, so tight on my budget that I cannot afford overpayment. God forbid that if you cannot afford your overpayment, that's fine. But if you cannot afford your mortgage, then your house may be repossessed. So I know that I'm sounding a lot of warning because, with such little equities in your home, you stand a risk of, getting into negative equity, or even remortgaging can be an issue if you don't build a lot of equity. Does that make sense? Let me know in the comment section what you think about this. Now, I'm going to tell you what are the alternatives. Shadrach, what do we do now? What are the alternatives? Skipton has what they call the Skipton track record mortgages, which simply, takes a record of your rent in the last, 12 months, in the last 18 months to see whether you've been paying your rent. So, for example, if you've been paying your rent, consistently for the last 12 months, in the last 18 months, then they are likely to give you a mortgage equivalent to your rent. So if your rent is say £1,000, then they'll calculate what mortgage can we give you so that your monthly payment is about £1,000. So that instead of paying your rent, you are paying your mortgage. And I think this, quite reasonable. Of course, it would impact how much they can lend you. But if you can get a mortgage at that price for a house that suits you, that means that instead of paying your rent to your landlord, you'll be paying your own mortgage. This also allows you to put down 0% deposit if you don't have any deposit at all. And this can be good for people who live in, an expensive place, or, because of their family sizes, they live in an accommodation that is quite expensive, and so they are unable to save, but they've been consistent in paying their rent. This means that you can leverage your rent to get a mortgage that is not so dissimilar from your rent to actually build equity into your own home. Does that make sense? I'll put a link to that deal in the description box below. Do check it out. And I think there are people who may be well suited to this deal. And it's also for first-time buyers. Of course, you still have the similar problem with possible negative equity, because if you put down 0% and the value of the property should drop in subsequent months or years, then it means you risk getting into negative equity. So where possible, you want to put down a substantial deposit. Otherwise, this can be a fair deal. I don't know what you guys think about the property prices, whether you think it's going to drop or it's going to rise, but that can influence your equity in the home. Barclays Bank also has what they call the Barclays Family Springboard Mortgages. And I think this is a beautiful scheme because it allows your friends and family to help you to purchase your first home. And that's how it works. You would have to open a special bank account where your friends and family can put, you can open more than one, where your friends and family will put this money in. So if you're getting, money from 2 friends or, 3 family members, you open 3 of these accounts and they will deposit the monies into these accounts, totaling the amount of deposit they want to give you. So let's say you want to buy a house costing £200,000 and they want to lend you, 20,000. Each of them can deposit this money, totaling the 20,000 into this account. You would not have access to the money, but while the money is there, it will be attracting some little interest. And then they will give you the mortgage of 200,000, not 180,000. They will give you the mortgage of 200,000 because you don't have the deposit. They give you that deposit, the mortgage, to cover the full value of the home. And then you now own the home and you'll be paying. But your friends' monies or your family's monies they've given you serves as a deposit for you. Does that make sense? Yeah, I'll put a link to in the description box below about the full detail. So they put that money down for you as an insurance sort of, whereby they'll also be getting some interest. And while you pay your monthly payment and you build equity to a point that at the point of remortgaging, you now have some deposit, some equity into the home, and they don't lose their money. Of course, if you miss payments, then there are other terms and conditions to be considered, which include actually losing the home if your friends are not willing to put their money down. So I think these are alternative schemes that can suit different people. If you've got some friends who are willing to help you, then this can be a better deal, because I think that each of these also influence the interest rate. It can help you reduce the interest rate while your friends are putting some of their money in the bank for you. So let me know what you think in the comment section. Which of these schemes you think is a better alternative? Do you think this Yorkshire Building Society deal is better, or you'd rather save to put down a deposit? Well, I hope this video has been helpful, and as always, do let me know in the comment section if this has been useful. Until the next one, God bless.